This short tutorial introduces a number of techniques for investment appraisal. The techniques we'll look at are payback and the accounting rate of return. Firstly, we'll consider payback. The payback on an investment is defined as the time required for the cash inflows from a capital investment project to equal the cash outflows. In this example, a company invests $100,000 in a project. The project generates incremental cash flows of $20,000 in year 1, $30,000 in year 2, $40,000 in year 3, and $20,000 in year 4. This total cash inflow over 4 years is $110,000. This gives a net cash flow of $10,000. To calculate the payback on this project, we must consider how long it takes the company to recover the initial investment of $100,000. We can see that the company recovers $90,000 in the first 3 years. As a cash inflow of $20,000 occurs in year 4, we can assume that $10,000 of this inflow occurred in the first 6 months of year 4. The payback on an investment is defined as the time required for the cash inflows from a capital investment project to equal the cash outflows. Thus, the payback period for this project is 3.5 years. The next investment appraisal technique we'll consider is the accounting rate of return. The accounting rate of return is calculated by dividing the average annual profit by the average cost of investment. Average annual profit is calculated over the life of the project. Average cost of investment is calculated by adding the initial cost of the investment and the value at the end of its useful life and dividing the total by 2. Let us consider an example of accounting rate of return. A company has 2 alternative projects, A and B, involving an outlay of $500,000 and $600,000 respectively. Each project has an economic life of 5 years. Project A has a residual value of nil. Project B has a residual value of $50,000. Company annual profits before depreciation are $200,000. Project A involves an outlay of $500,000. Project B involves an outlay of $600,000. Company annual profits before depreciation are $200,000. Over 5 years, this totals $1 million. Each project has an economic life of 5 years. Project A is fully depreciated to nil residual value over 5 years. That is, total depreciation for Project A is $500,000. Project B has a residual value of $50,000. Thus, total depreciation for Project B is $550,000. Profit after depreciation for Project A is $500,000. Profit after depreciation for Project B is $450,000. As the project duration is 5 years, the average net profit for Project A is $100,000, and the average net profit for Project B is $90,000. Thus, for Project A, as the average profit is $100,000 and the average investment is $250,000, the ARR is 40%. And for Project B, as the average profit is $90,000 and the average investment is $325,000, the ARR is 28%. Hence, the accounting rate of return for Project A exceeds the accounting rate of return for Project B. This short tutorial introduces a number of techniques for investment appraisal.